Natural gas is at a historic turning point right now. The global natural gas market is reacting to disruptions in the Strait of Hormuz and growing AI power demand, while the yield curve is flattening. In this video, you will understand why the American Henry Hub natural gas price is currently diverging away from the European and Asian benchmarks, how rerouting changes global flows, and why liquidity conditions may matter just as much as supply and demand. That is the framework you need to read gas correctly. Let us begin by first understanding the driving factors of global natural gas prices. First, there are fundamental factors which are describing the physical reality of the market, how much gas is being produced, how much is exported, and where the demand is coming from. Then there are structural factors which translate these fundamentals into a global trading framework. The price relationships between benchmarks like Henry Hub, TTF, and JKM, the spreads between regions, shipping routes, choke points, and the broader dynamics of how gas and LNG actually move between nations and continents. And lastly, there are financial factors. These are essential to understanding natural gas not just as a physical commodity, but as a liquidity-sensitive asset. Financing costs, interest rates, and the dollar funding conditions, which are often left out in many natural gas analyses. So let's begin with the fundamentals. If global energy demand is represented as 100 units, then approximately 25 units come from natural gas. Of those 25 units, 10 units are used to generate electricity, 7 units are used in industry, 6 units are used in buildings for heating and cooking, and 2 units are used in transport and other applications. This chart shows you that demand for electricity generation has been rising over the last few years, especially due to AI infrastructure buildouts. As most of those data centers get their electricity from gas turbines, this directly translates into rising natural gas demand globally. Now the question is, can this rising demand for natural gas actually be supported by global natural gas supply? If you take a look at global natural gas production in 2024 and 2025, you can see that after the US, nations like Russia, Iran, and Qatar have been making up a big portion of production. But more importantly, two of them, Russia and Qatar, are also one of the biggest natural gas exporters. This is important because over the last few years, and especially in the last few months, those nations witnessed significant damage to their ability to export natural gas. Russia experienced immense infrastructure damage, including the permanent destruction of the Nord Stream pipelines in September 2022, and additional pipeline disruptions that further reduced export capacity. Iran's ability to export natural gas has also been very limited as it suffered sanctions, and since the last few months, also gas infrastructure and the Strait of Hormuz choke point are threatened. This is not only threatening Iran, but also Qatar, which is exporting around 20% of the global LNG supply. If you take a look at transit trade volume of tankers passing the Strait of Hormuz, you can see volume picking up slightly following the peace negotiations. However, this is not even coming close to transit volume seen previous to the war. So, concerning the fundamental factors, we are seeing demand being expected to grow, while the supply side is at risk because of gas infrastructure being destroyed and trade through the Strait of Hormuz being restricted. Now this obviously brings up the question of how this demand-supply imbalance is actually going to translate on global natural gas trade. This map shows the volume of tanker traffic flows at risk of being affected by the recent disruptions in the Strait of Hormuz. These estimates show clearly that most of the tankers after transiting the Strait of Hormuz have been primarily traveling to European and Asian ports. That's why the closure of the Strait of Hormuz is primarily affecting Asian and European natural gas prices, which is also what the charts are supporting. You can see that after the war started, the European benchmark for the price of natural gas, the TTF, as well as the Asian benchmark, the JKM, have been rising significantly, while the American benchmark Henry Hub actually continued to decline. What was following was a rebalancing, and this is a key concept to understand. Think of those regional benchmark natural gas prices as a magnet. Whenever they rise above the others to a certain extent, tankers are rerouted to sell at those places, now offering higher prices. Now, because the Henry Hub price is currently low relative to Asian and European prices, US natural gas exports are rising as natural gas is flowing from the US to Europe and Asia. So before we continue with what most analysts are currently missing concerning natural gas, please take a moment to make sure to subscribe to our channel and hit the like button if this was valuable to you this far. Thank you. Now, it is crucial to understand that natural gas is a commodity that is not only influenced by obvious supply and demand dynamics, but also by liquidity conditions in the financial system. To visualize the existing liquidity conditions, we like to take a look at the yield curve. The yield curve is describing the spread between the yields for long-term and short-term treasury bonds, in this case the spread between the 10-year and 2-year treasury bond yields. And as you can see, that yield curve is moving in cycles. You can think of it as a representation of the liquidity cycle, sometimes also called business cycle, which is closely followed by assets like natural gas. The shape of the yield curve essentially captures three forces that drive natural gas prices. First, it reflects economic activity. A steepening curve means expansion. Industry is running, power demand is rising, gas consumption follows. And flattening curve means the opposite, slowdown with falling demand across manufacturing, chemicals, and power generation. Second, it determines financing costs. When the curve flattens or inverts, banks earn less on lending, which obviously results in banks lending less in the future. At the same time, traders lose credit capacity, storage trades become harder to finance, and less gas gets injected. Therefore, the winter supply cushion quietly shrinks without a single molecule of production changing. Third, inflation expectations. Normally, a flattening curve means inflation is cooling and financing costs ease. But right now we have a bear flattening where short rates are rising as markets price in Fed hikes, while long rates staying anchored. That means storage costs rise immediately, credit tightens, and international buyers face higher dollar funding costs. This is the lens through which the entire financial layer of the natural gas market should be read. So let's combine all of this. Regarding the current supply and demand dynamics in the global natural gas market, we do have a supply-demand mismatch. Important supply chains are disrupted, especially traffic through the Strait of Hormuz, while demand is rising as natural gas is critical specifically for electricity generation powering the growing amount of data centers. Asian and European gas prices have been surging as those continents are highly dependent on natural gas coming from the Gulf region. In result, US natural gas exports continue to rise as natural gas is always flowing to wherever spot prices are highest, in this case Europe and Asia. So we are currently witnessing a phase of rebalancing. But here comes what most investors are missing. It's important to view all of this through a financial lens because as the yield curve is illustrating, liquidity conditions are currently deteriorating. In other words, traders lose credit capacity, which causes storage costs to rise immediately as international buyers face higher dollar funding costs. We conclude from this that even though natural gas supply is disrupted, the demand side will not necessarily continue to rise. In fact, we are likely witnessing the late stage of the liquidity cycle, typically causing natural gas prices to decline before we do see this happening all over again. So if you have any further questions, don't hesitate to ask them down below in the comment section. And if you found this analysis valuable, please subscribe to our channel and hit the like button, as it helps us reach out to more people who need to understand what is currently happening. Thank you for your time.